Hello and welcome everyone participating in today's webinar, Introduction to Indirect Rates under Uniform Guidance. My name is Yevgeny Suhenko, and I'm a manager here at GRF CPAs and Advisors, and I'll be today's webinar moderator. So before we dive in, some quick housekeeping items, what you're going to need to know to earn CPE credit. Anybody seeking the CPE credit is going to have to complete and submit a short evaluation survey that's going to appear automatically after the webinar is done. You're going to be asked to recall CPE words that we're going to give throughout the webinar. So please write them down as they're not going to be given at the end, and you will need these CPE words for the CPE certificate. Once again, they're not going to be provided at the end, so please write them down as they're provided. If you have any technical questions or issues during the webinar, please use our chat function and speak with our administrator for assistance. The slide deck and the recording from today's discussion is going to be made available on our events page on the GRF website. Any technical support or CPE questions may be addressed to Nathan at nmclevine@grfcpa.com. So with that, today's learning objective is to provide an overview of the impact of uniform guidance on indirect rates and allocations for preparing a nonprofit indirect cost rate proposal. And with regards to our speakers for today's webinar, Paul Calabrese is a principal in our outsourced accounting and advisory services department at GRF. Mr. Calabrese brings a successful track record of working with government contractors. He has a remarkable career, including positions with the Air Force Audit Agency, Defense Contract Audit Agency, DCAA, 3 government contractors, in addition to his 20+ years in public accounting. Mr. Calabrese's extensive experience with the cost accounting standards and cost disclosure statements, federal acquisition cost principles, uniform guidance for federal grants, positions him as a sought-after resource and consultant for all facets of federal government contract and grant cost accounting. Joe Amiri is a senior audit manager at GRF CPAs. With more than 10 years of experience, he's developed specialized expertise in consulting international NGO clients on complex audit and accounting matters. He also works with INGOs ranging in size from 500,000 to over $1 billion in annual revenues and missions that span several continents. As part of his role at GRF, he travels the world and visits remote locations to perform audit work for organizations with operations in Africa, Latin America, Middle East. And so with that, I'm going to turn the presentation over to Paul.
Thank you. Thank you, Yev. Before we get started, we just want to let you know that this is part 1 of 4 parts. Today, we're going to be introducing the indirect rates under the uniform guidance. And part 2 will be relating to the cost principles, so part E. There'll be a part 3. There'll be practical guidance for building an indirect rate for nonprofits. We'll kind of go over how to build it. And then the 4th part will actually be the literal mechanics of putting an indirect rate together from a statement of functional expense. And now I'm going to turn it over to Joe, our wonderful auditor person.
Thanks, Paul. So yeah, in this first part, we're going to go over from a high level perspective, what are indirect costs and what is an indirect rate, to make sure we're all talking from the same basis as we start to dive into the different methods that the U.S. government allows under the uniform guidance to recover indirect costs, ranging from the 10% de minimis rate to direct allocation method, and to the more sophisticated NICRA, which is Negotiated Indirect Cost Rate Agreement. Throughout the session today, we'll also be referencing several different COFAR interpretations, which provide additional clarity and guidance as far as what the uniform guidance truly allows and perhaps does not allow throughout the session. So first, starting off, it's good to have a good understanding as far as what really do we mean when we say indirect cost. And for those of you that might have more of a background in the commercial or for-profit realm, a lot of people consider these more the overhead type costs. And so they're costs that are incurred for a common or joint purpose, benefiting more than one cost objective. they're not readily assignable to a cost objective specifically benefited. So basically, they're the collection of costs that don't directly attribute to one specific program or purpose. A lot of times, especially for an NGO organization, these are going to be the costs that are incurred at the headquarters office. Things such as the CEO or executive director's salary, a lot of times accounting, finance function, IT, things that, are benefiting every project an organization does, but, there's not a direct correlation to that specific project. It's not easy to allocate those costs on a fair and equitable basis to all of your projects. So what many organizations end up doing is putting all these indirect costs into a pool or a bucket of costs that are then allocated on a reasonable basis to all the projects that you work on. And that process is really done through an indirect rate calculation, which is, there are many different ways to calculate an indirect rate, and we'll talk about a few of those today and throughout the rest of this 4-part series. But your indirect rate is the calculation of indirect organization's indirect costs presented as a percentage of direct costs. And again, we'll talk a lot about how much variety there is as far as, what costs are treated as direct versus indirect. And so, really off the bat, I want to kind of emphasize that the percent that people calculate for their indirect rate, it's nearly impossible to compare to another organization's percentage when they calculate their indirect rate, because it's really based on the definition as far as how you're calculating and allocating those costs.
And I think that's a great point that he brought up. We tend to want to compare ourselves to other groups, but they all base their indirect rate computation a little bit different in their allocation base. And so the best way to analyze your own rates is against yourself in a comparative way, such as from year to year.
Great. So one of the first FAQs we want to bring up and make sure that, again, that we're all on the same page is that there is no requirement under uniform guidance to have an indirect rate. Of course, I think it's best practice, and definitely would suggest and recommend that most organizations, unless maybe you work on one project only in your organization, have some sort of method of recovering indirect costs. The U.S. government tries to be transparent and wants to pay for the work and projects that your organizations are performing. And so, there's different ways to recover those costs, but at the end of the day, there is not a requirement to have an indirect rate. But in this FAQ, essentially what the COFAR is recognizing is that, there are some organizations that are able to 100% allocate all their costs directly to their projects. Typically these are organizations that, they have one project that they're working on, and every dollar they spend supports that one project, that one objective, maybe 2 or 3, but once you get to 4 or more different types of projects, it becomes a significant hassle and burden to directly allocate all those costs. And in a few slides, we'll talk a little bit more about the direct allocation method. But on the high level, there is no absolute requirement to have an indirect rate. So going into one of the first ways in which organizations can recover indirect costs from the U.S. government under the uniform guidance is called the 10% de minimis rate. And here we also included a citation to 2 CFR 200, where most of this information we're presenting is coming from. So for those of you that want that reference and be able to go back and look at the authoritative guidance, it's found in 200.414 paragraph F. And so the 10% de minimis rate is available to any organization that does not currently have a negotiated indirect rate, even if you had a prior NICRA or negotiated rate in the past. And that's a change that came last year when the uniform guidance was revised. So every 5 years, the OMB goes through and makes revisions to uniform guidance to make sure it's up to date with current business practices and so forth. And so That was a good change, because in the past, if you had a NICRA, say 20, 30 years ago, but no longer maintained that NICRA agreement, you were not allowed to use the 10% de minimis rate. And what the OMB determined was that, you know, that shouldn't prohibit an organization from using this rate. So now it's available to every organization that does not currently have a negotiated indirect rate. And what the 10% de minimis rate is basically the US government says they will pay you 10% of your modified total direct cost base. And that's a very key part of this, because that's not total direct cost. So they're not paying 10% of all of your costs, but it's modified total direct cost. And on the next slide, we'll talk about what are those items that they exclude from direct costs to arrive at that modified total direct cost. And once you start using this rate, you can use it indefinitely until you end up negotiating a NICRA rate with a cognizant agency. You know, and the nice thing about it is that, you know, direct and indirect costs can be charged consistently, but you cannot double dip. And there's, under the 10% de minimis rate, there's no audit or tie back to actual costs incurred. You know, once you start using this rate, the US government pays you that rate, and you don't have to go back and verify and prove that you incurred all those costs. So in some instances, you know, it might actually pay more than what you would incur of your indirect costs. But the opposite is true as well. You know, I think in most situations, you know, you end up incurring more costs than what they end up reimbursing, but there's no audit or trail that you have to tie back to the costs incurred, which is unique compared to the other methods of indirect cost recovery.
One point I'd like to add is that there's a class deviation. If you are under HHS rules, which they have their own regulation, almost everyone else comes under 2 CFR 200. HHS is very special. There's a lot of funds that flow through there, and they're under 45 CFR 75. And when you go to the 75.414, whatever the equivalent rate is, if you're dealing with HHS and a foreign entity, the so-called de minimis rate or whatever is actually 8%. And they got a class deviation. This is only if HHS is dealing with a foreign entity. The second thing I wanted to share with you and bring to your attention is why would an organization that had a NICRA want to go back to a 10% de minimis? And sometimes what happens is that large organizations get access to some federal funding, and they're significant in size, and then all of a sudden, for whatever reason, they're not going to have significantly large awards. And so for them, it makes it a lot easier, you know, very, very large organization. I'm spending a lot of time. My system is not so much set up for cost accounting and structures the way that the uniform guidance is set up to develop an indirect rate. And so I have to do a lot of analysis and pulling records from here and there to get to that final rate. And so since now instead of having, let's say, 5 or 4 million in directly funded awards, I have, let's say, less than 1 million, may still have greater than 750 or maybe even less. And it just does not seem worth the effort to use that NICRA anymore. And just for time, to save time and resources, they decide to go to the 10%. So that's some of the reason you kind of scratch your head and say, well, if you can get more return, why not do it? But at some point, if it takes such a large effort and your awards are very small in dollar amount, that you may choose to go back to the de minimis.
Great. So when we talk about the 10% de minimis rate, we mentioned the modified total direct cost. And this is the basis in which you'll calculate the 10%. So how you arrive at that is you take your total direct costs on the federal award without the following items. So you subtract out these items to arrive at the MTDC. The first one here is the portion of each subaward in excess of $25,000. So for every subaward agreement you have, let's say you have an agreement with a subrecipient that is 100,000, you would back out 75,000 of that award of those direct costs that you're paying through to them, and only take 10% of the first 25,000 of that subaward. And that one really is a big item that, you think 10% of total direct costs. Well, once you back out all, if you have a lot of subaward costs, it's going to drastically change the amount of indirect you're recovering. The other items listed on here are other ones that the U.S. government says they will not pay the 10% indirect rate on if you're using the de minimis calculation on. And that includes, listed here, equipment, capital expenditures, charges for patient care. So those are more for hospital-related organizations. Another key one is rental costs. So any rental cost, whether it's your office rent, renting vehicles, and so forth, any rental costs are excluded from the modified total direct cost base. The next two relate to university and institutions of higher education, tuition reimbursement, scholarships and fellowships. And the last area is participant support costs. So any payments that you make to participants, not to your own employees, but to participants for allowances for attending workshops or travel allowances and so forth, those also must be backed out of the equation to arrive at modified total direct costs. And at that point, that's the amount of that you apply the 10% to in order to be reimbursed for your indirect cost recovery.
I just wanted to share that with respect to subawards, just please remember to note that with subawards, it's over the life of the subaward. So if the subaward goes on for a couple of years and it's one particular subaward, then the 25,000 is just that one time, and then for the rest of the subaward, obviously, that's in excess of 25,000. The other thing that's interesting is with rental costs. What we're finding is that some people, because they don't have a negotiated indirect rate, a NICRA, so they want to get something allocated, some portion, some significant administrative costs, and probably the largest one is rent. And we're talking about office rent particularly. And so you're going to see that a lot. But then if you have a de minimis rate, as we're going to see shortly, maybe and just shortly, we'll see the impact that what a removal of rent or subawards has on a negotiated rate versus a 10% de minimis rate. So, but we do see a lot of direct charge rent on some allocable basis because generally that organization wasn't able to get a NICRA.
Perfect. All right. Thanks, Joe and Paul. So with that, we've reached our first polling question. And our question is, does the modified total direct cost base adjust for the 10% de minimis rate as it does for the NICRA rate? Pretty simple responses: A for yes, B for no, and C for unsure. So please take a moment to answer. While everybody's registering their responses, I'm going to provide the first CPE word. The first CPE word is equipment. Again, just a reminder to everybody, you're going to need these CPE words given throughout the webinar for the CPE survey that's going to follow and to get your certificate. Once again, the first CPE word is equipment. EQUIPMENT.
All right, so we got the results in here, and fairly even distribution of people saying slightly more saying yes, about a third saying no, and around 20% saying unsure. And what we're really trying to get at here is that the modified total direct cost base adjustment for the 10% de minimis rate. There's a lot of discussion in the federal granting community currently that that basis is the same once you end up applying for a NICRA rate, and that is not true. depending on the awarding agency and everything, and Paul will get into this in more detail later in the session, but the NICRA rate is a negotiation between you and the federal government in which you'll, everything's on the table and you can negotiate what that rate base is to calculate your indirect cost. But the modified total direct cost, a lot of agencies and different people are trying to kind of push more towards that for the NICRA, but in 2 CFR 200 it is not explicitly stated that those are the exact same basis. So to kind of look at the numbers a little bit here, when we talk about the de minimis rate calculation, to highlight basically that the 10% is not 10% of your total direct cost base. What we've shown here is in NICRA step 1 or the indirect rate, with a very general indirect cost rate recovery to where you recover your basis is your total direct cost. So when we say indirect base, we really mean your total direct cost. And in your indirect pool, your collection of all your indirect costs, you have $100 of indirect costs, and your base, your total direct costs are 1,000. And so in that calculation, if you're recovering that amount, that's 10% in which you're able to recover. But in the second example here, that in order to recover that $100 of indirect cost base or pool, when we look at the modified total direct cost and the fact that that excludes subrecipients greater than $25,000, and in this situation where our example is saying half of those direct costs are subrecipients in excess of $25,000, following that same methodology, the indirect rate you'd be recovering would be 20%. But as we've discussed and clarified, the de minimis rate does not allow you to recover on those subrecipients greater than 25,000. So at the bottom, what we've shown is that for the same exact scenario, your base of $1,000 of direct cost, your base becomes $500 because of the subrecipients in excess of 25,000. And so when you take the 10% of your modified total direct cost base, you end up only recovering $50. So you end up only being able to recover half of your indirect cost under the de minimis rate calculation. And so that really just tries to highlight and emphasize, on the one hand, having the 10% de minimis rate is a great option because you don't have to tie this back to any costs that you're incurring and so forth. And for an organization that hasn't gone through a negotiated indirect cost rate process, it's a great option to have there. However, be cautious of thinking your indirect rate recovery is 10% because of all the different items that we just mentioned have to be excluded from the calculation. So we get on to another FAQ from the COFAR here. And this one really has to do with the 10% de minimis rate and single function, NFE stands for non-federal entity. So an organization that's not part of the federal government. And this gets to a point we discussed earlier, but the 10% de minimis rate cannot be used if you're a single function non-federal entity who charges 100% of their cost directly. So if every cost you incur as an organization, you charge 100% to your projects directly, well then in that situation, the U.S. government is saying, all right, we're already paying you for every cost you're incurring. We're not going to pay you another 10% on total modified direct cost because that just becomes pure profit. And so the theory behind the 10% de minimis rate is really to pay for indirect costs that are not easy to directly allocate to your federal award. So if you're an organization that is in a situation where you can directly allocate everything to federal awards, then this FAQ is clarifying you cannot also take the 10% de minimis rate and recover a profit from the U.S. government. And this FAQ is really important because there is no direct connection between costs incurred and the 10% de minimis rate, but the federal government here is clarifying that if you charge everything directly, you cannot also recover a 10% de minimis rate. And this really is in essence clarifying this portion of 2 CFR 200 in which you cannot double charge. So under the uniform guidance, you know, the U.S. government as a donor tends to be really fair and reasonable. They might have a lot of requirements that you have to comply with and so forth, but as far as paying for the cost of the project, you know, they tend to be very reasonable. But one of those aspects of them saying, all right, we'll pay our fair share, is that you cannot double charge. So, you know, if there's a cost that you're charging directly to federal awards, you need to treat that consistently. So each item of cost incurred for the same purpose must be treated consistently in like circumstances, either as direct or indirect. And this is really just looking at trying to avoid double charging the federal awards and not charging for something twice as a direct and indirect cost. So now moving into kind of the second way in which organizations can recover indirect costs from the federal government is through a method that's referred to as direct allocation. And what direct allocation does is it really has an organization, you know, for costs that you can identify specifically with final cost objective, you know, you can directly assign those costs or activities to a federal award, as long as you can do it easily with a high degree of accuracy. You know, so many times it's not an easy, even, clear split. This is 50% this project, 50% this project. But if you can come up with a reasonable basis as far as how you would allocate those projects directly to a federal award and other awards, then the U.S. government allows you to charge those directly in order to recover these type of costs. And so as far as admin staff wages, which the most common place I see this directly allocated is with NGO organizations that are working around the globe. You know, a lot of times the costs they incur in their project offices or countries they're implementing projects in around the globe, they'll oftentimes directly charge the admin staff to the projects that are being implemented in that country, with kind of the mentality and basis thought process that, you know, they wouldn't have office or admin staff operations in that specific country if it weren't for those specific projects. And so then therefore they directly charge the admin staff wages, and that's allowable and appropriate when all of the items here listed are met. You know, the administrative services are necessary to a project. Individuals involved can be specifically identified to the project, most commonly done through timesheets. Administrative wages are included in the budget or prior written approval from the agency. So essentially, you're not trying to hide this in the process. You're being upfront as far as this is how you're going to charge the federal government for these type of costs, and such costs are not recovered as indirect costs. So again, you're not double dipping on those costs.
Hey, Joe, sometimes have you seen also in the field, so to speak, in other nations, that when it comes to fringe benefits, they're actually charging everything direct because instead of having a fringe rate? Have you seen that?
I have, yeah. You know, I've seen a lot of times, you know, every cost that's related to the overseas operations, the country office, you know, they come up with a direct allocation method to charge those directly to the projects in that country or region, yeah. So again, kind of looking at what the principles say on the direct allocation method is that if a cost benefits 2 or more direct programs, you know, and you can find a reasonable way in proportion to determine without undue effort or cost. So basically an relatively easy way to allocate these costs directly, then you can allocate them to the project. You know, so an example would be summer workshops. You know, you have 2 different projects or donors, funders, two different grants that are paying for a summer workshop for, elementary school kids. And, all those costs of that same summer workshop that they're attending to, you could directly allocate those costs based on the number of kids or students that are attending from each project, and use that as a basis for how you're going to directly allocate, the cost of the summer camp rental, any materials that you have to procure for it, because you have a reasonable basis to allocate between the two different funders or grantors. And so if the items previously that we just talked about, can't determine proportions based on the interrelated of the work involved, then you allocate it on benefit of project on a reasonably documented basis. So what is a reasonable basis? So I think the most common one I'm aware of is with any sort of IT related costs or infrastructure items. I often see organizations will directly allocate those to projects based on the number of devices used by that project. So, if you have 100 laptops and 50 of them are being used by staff on project A, 25 are being used by staff on project B, and 25 are being used by the admin or overhead type staff and everything, then every cost related to the infrastructure of the IT department, could be allocated directly based on that calculation of 50% to the first project and 25% to the second and 25% to the overhead, or and so forth. So but the other thing to mention here is that purchase of equipment or capital assets for a specific award are assignable to that award only, regardless of use on other projects, or no longer needed as acquired. So if you buy a laptop for a specific project, then that's where you charge, and that's the purchase of that specific laptop. And so some items to consider, if you're using the direct allocation method, we often see organizations use square footage for this method. So, how much square footage of the office space does each project team maintain and use, and using that to allocate different costs. That is allowable, but that's often difficult to measure and difficult to keep up to date. As each project grows or shrinks, it takes a lot of effort to go back and redo that calculation and make sure that you're being fair and reasonable in the process. So if you use that as a way to directly allocate, just be sure that you have a process to make sure as things change over time that you're updating for that as far as how you're directly allocating costs. And if you're using direct allocation method, again, it needs to be transparent that this is the process with your grantor. And so make sure, in the budget, there's a line item for joint costs or occupancy, other line items. So you're clearly calling out it's a direct allocation that you're using. And within your accounting system, you need to have a way to track all these costs and be able to show, because for me as an auditor, if I'm coming in and looking at your project and so forth, there needs to be a clear trail as far as how you're putting all these costs into the bucket, if you will, and then what's the fair and reasonable basis you're allocating it to all the projects, and how is that determined? And the direct allocation method is used if there's no negotiated indirect rate.
Okay, so now what we're going to do, if you could show me the first item there, thank you. This is like a diagram of the direct allocation method. I think when we talk about this so often, and we deal with indirect rates every day, but some of our clients don't. We think it's a little bit more helpful if we have a graph or a diagram to explain the difference between the direct allocation method and the simplified. And so basically in this situation, what's happening is that rent itself, total amount of rent, often it's occupancy, but we're just limited to rent, is allocated directly to a grant, to the indirect pool, to the contract, and to the other contract. Now in this situation, they may not, as Joe had correctly said, they may not be a NICRA. And you might say, well, why is there still an indirect cost pool? Because they still need to track management in general for the 990 or for the statement of functional expense. So they may still have structures for it, but rent itself is kind of allocated on some pro rata basis, could be square foot, could be dollars, hours, FTEs to these different items. If you could do the next graphic. So we just want to make it clear that in this unique situation, rent is not going to be charged to the indirect cost pool. The rent you're seeing in the indirect area or arena, like management in general, only represents the rent for administrative personnel. Okay, and then the last graphic. The last graphic shows you what most individuals and organizations have seen, and that is a simplified allocation method where rent at the top here is being allocated via the indirect pool. And so that rent is both direct purpose rent and indirect rent, and both of those rents sit in the M&G, or you can call it G&A, or you can call it facility administration, but it's sitting in the indirect pool, and then the indirect rate allocates it to a grant, a contract, and so forth. Okay.
Great, thanks, Paul. And so before we move on, we're now on our second polling question. And our polling question is, does your organization charge administrative type costs like rent direct to your grant or your cooperative agreement because you don't have a negotiated indirect rate? So the answer choices are, we're a subrecipient on all of our grants or cooperative agreements and don't qualify to have a NICRA and are thus using the 10% de minimis rate. Option B, we have a history of charging items direct because we did not think it was worthwhile in the past to obtain a NICRA, and we currently have direct or prime awards. Option C, although we have direct or prime awards, there are material to pursue a NICRA. Option D, we have direct or prime awards, but we want additional information on how to prepare a NICRA. Option E, we currently have a NICRA. Option F, although we have a NICRA, we have questions regarding allocations, the rate, or the process in preparing the rate. And option G is none of the above. So again, while everybody's taking a moment to record their answers, I'm going to provide the second CPE word. Our second CPE word is project. Once again, you're going to need this second CPE word and the first one I gave earlier to answer the survey that's going to follow our webinar and obtain your CPE certificate. Once again, the second CPE word is project, Project.
Okay, so you can see that there are a lot of people that are in a variety of situations. 42% have a NICRA. So, and then the others are in various situations where maybe they want one and they need one, or they just, at this point in time, having it, sticking with the de minimis makes more sense. Okay. And I also think it's kind of helpful to let other people, even though you don't want to know what the name of the organization is, just kind of see what is happening in the industry. Unallowable activities basically receive an allocation of indirect cost. So those basic ones would be like fundraising, membership, lobbying, which you may call advocacy, fundraising you may call parts of communication or development. And so we got the membership, the fundraising, and public relations is the other one. So they'll be treated like a direct functional type of cost. It may be a functional area, but it will be treated as a direct cost receiving its portion of indirect. And the reason why this is important is that when we do a statement of functional expense, we take that from the audit and we begin to adapt that statement of functional expense to a methodology for which we can compute an indirect rate. So fundraising, those generally programs, fundraising, and M&G. We then take the fundraising and we move it over with program, and we call them together the part of the direct cost base. All right. Joe, you have anything you want to share? I don't want to.
That's good.
Okay. The next slide. Okay. So payments have to be made if you have some unallowable costs and you got to pay it back to the government. And this wasn't a requirement prior to the uniform guidance coming into effect late December 2014 and into 2015. But now if you have unallowable expenses and the government's found it and questioned it and sustained it, you have to pay it back, and with interest. And interesting. So the question I have for Joe is, have you seen that as an auditor where people are literally like either paying it back or with interest? I'm just curious.
We do see it, not in a, I guess, material sense typically, which I guess I'm thankful. I'm not auditing organizations that have been collecting unallowable costs for a significant period of time to where it becomes a material issue type thing. But yes, I have seen it to where, there are some unallowable costs and they have to be repaid to the federal government. Absolutely.
Okay, and you can see some of the reasons for determination of an item being unallowable, either being determined as unallowable first by regulation or law, by a unique statement or class deviation for a particular agency, or the cognizant agency for determining indirect costs would be like for a health and human service, it'd be cost allocation services, could be your pass-through entity, and it can be either a direct or indirect unallowable cost. If it's a direct unallowable, it actually stays within the modified total direct cost base. It's not removed. You might think it should be, but it doesn't. It receives its allocation of indirect cost. So now we move on to a very important part that interests a lot of people, and that's the actual negotiation of your indirect rate. And it's interesting and quite special that the US government writes in there that, due to the diverse characteristics and uniqueness of every entity, nonprofit, institute of higher education, state and local tribe units of government, or hospital, and even commercial firms, that, we really, as a government, can't dictate the type of indirect rates and so forth. You're free to develop whatever makes sense and is logical as long as you're consistent. We know in reality that's not. You're going to be dealing with various agencies like Health and Human Service or U.S. Department of Labor. Those two have the most common rate templates, which we'll get into in future sessions. And they kind of do put you into a box. They have, you can get your fringe rate negotiated, that's very rare, but often when we prepare indirect rates, we still provide them a fringe rate just so that the government can see what it is. And you compute your indirect rate, but it's what they call a facility and administrative rate. And there's just certain ways that they permit the denominator. And I'll just briefly say, it's either this modified total direct cost base, or you can do salaries and fringe benefits, or just direct salaries. So the actual negotiation is the agency that has your largest dollar amounts. So, and that can change over time, and I don't believe that you should be changing that every year. But basically, it is the agency that has the largest dollar amount. And you would see that in your schedule of expenditure of federal awards, which we often call the CFA. And in the CFA, so based on that, if it's mostly with Health and Human Services, if it's Department of Interior, and something of note, say you have an awards and they're all around the U.S. Department of State. Well, state doesn't have that capacity. They sub it or consult it out to the U.S. Department of Interior. I think agriculture does too. So in some cases, depending upon the agency, your agency may give it to another group to actually compute the rate. CNCS Corporation or National and Public Service, something like that. They use HHS, HUD uses HHS. So it's just something to be aware of as you go through it. If you have a new award and it is your first award for which you would qualify to have a micro rate, then you have 90 days to get in that rate. Most people, right, can't wait to submit and get that micro rate approved. And of course, if that happens and you're starting with a 10% de minimis rate in your application, so you get an award, it's a prime or direct award. And so you have that award. What I'm trying to say is that you start with a 10% rate, knowing that your real actual rate, let's say, is 23%. So you're going to have to take 13% from program, and you'll have to do some kind of budget realignment to affect that. So there's things that are going on there that you need to be preparing for in your negotiation. Sometimes people won't be able to do any kind of micro rate. There are a few unique programs, especially around HRSA and the Ryan White program, and statutorily, they have limited 10% direct or indirect administrative costs. So just be aware of that. Now, someone has let us know that there's some questions. Yev, do you want to read any of those questions so we can kind of, as we go along?
Sure. Yeah, I can start with the three we have so far. So one participant asked, is the subaward backout only for federal grants or federal contracts as well?
Just federal subawards. You want to say anything, Joe?
Yeah, no, I agree. It's federal subawards, and I would look at a common, I guess, challenge is, is this a grant or a contract? And, the 2 CFR 200 actually has kind of clarified, that it's more about the substance than the form of the agreement. And they give a few different kind of areas to really make sure whether it's a grant or a contract, or another way to put it is assistance or acquisition type thing. So.
Got it.
Yeah,
Okay.
what's the second and third questions?
The next question is, there was one question relating to, I think, a particular slide regarding interest. So I'm going to skip that one for now. If the participant wants to clarify that, I'm happy to answer it later. The next question is, for subrecipients that are applying for the de minimis rate but did not use the modified total direct costs, does it need to be corrected in order to avoid unallowable costs?
Say that one more time.
So for a subrecipient that's applying for the de minimis rate, but did not use the modified total direct cost, I guess, adjustment that we were referring to, does that de minimis rate now need to be corrected in order to avoid unallowable costs?
Well, it needs to be straightened at some point so that it's on a modified total direct cost base and any reductions through it. And so it would be surprising if through the application that the government itself didn't ask them to correct the computation in their budget application. But if not, then yes, at some point it would have to be.
Got it.
So
Okay.
Let's move along
Mhm.
and talk about, if you have an ongoing NICRA from year to year, then you have 6 months after your fiscal year end to give time for the auditors to do their audit, because your NICRA submission should be based on your audited financial statements. So you have 6 months after year end to get it in. Usually the government's not tracking you down on it unless you're very large and it impacts a lot of the federal money, and will be, determined because you have an indirect rate in there. But technically you have 6 months after fiscal year end. Predetermined rate is based on estimate of cost to be incurred in the current or fiscal year. It's rarely used, but it does exist. Fixed ceiling rates are similar to the predetermined, except the difference between the estimated and the actual cost basically are carried forward to the future year. I've seen a lot of this, particularly with NOAA and the Department of Commerce. This is a very bad kind of methodology because you're always putting into a future year the adjustment, and it's like a dog chasing a tail. I have a lot of trouble myself, and I'm years in cost accounting and working with clients and trying to figure out what is the rate for that particular year. So what we find is the most common and the best, and if you have impact, to say to the government, if they're going a fixed rate, say, no, I'd rather have a final rate. The final rate is based on historical costs for the prior fiscal year for which your indirect NICRA is based on. Once negotiated, it's not subject to adjustment. And that's the most common one used. Okay, the provisional rate is just a temporary, whatever your historical rate is, that becomes your provisional rate for the next year, and it's distributed to awarding agencies. Negotiating the rates are applicable to all federal agencies, but agencies can have an impact if you're very large and stating what they would prefer to see as far as being involved in negotiation. One last point on that prior slide, but don't change the slide. Some people can say, well, where is the office to negotiate an indirect rate? Looks in your terms and conditions of your awards, and you'll find it there. If you have a very, very large amount of direct awards greater than 10 million, you're supposed to break out the facility from the administration piece in your indirect rate. I've worked with HHS, and I work with an entity that had, their size was 240 million, and they definitely had way over 10 million in direct awards. And even though we broke it apart, HHS still said we like to see one rate. Next slide.
All right, perfect. So before we wrap up, reach our third and final polling question. And our question is, the regulations have always required recipients of grants and cooperative agreements to charge the full amount of their NICRA rate. Is that A for true, B for false, or C for unsure? While everybody's registering their answers, I'm going to provide the third and final CPE word. That word is subject. Once again, you're going to need all three words we've provided throughout for the survey that's going to follow and to get your CPE certificate. Once again, the third and final CPE word is subject. SUBJECT.
Okay, this is good. But 57% got it right. It's false. Okay, let's move on as our time is limited. So basically you can, under FAQs, voluntarily decide to charge less. There are a lot of reasons for that, but as long as the government technically isn't forcing you to do it, you may charge less. Sometimes I've seen rates like someone was dealing with U.S. Department of Justice, and they went up with a NICRA rate that would be like 44%, and they just realized that's just way, way, way too high. If the unique situation and circumstances of their organization resulted in a very high rate, but they decided to go to something much, much less, like around 30%. This is not, if you're in that situation, you do not have to do that. I'm just sharing with you experience. Next slide. These next two slides, this one and the next, are important because basically it is the pass-through entity's responsibilities. And this is a situation where you are a subrecipient and you're dealing with a pass-through entity, and the effect is that you don't have a NICRA rate, so you must deal in accordance with the pass-through entity as a sub. And if you notice here under the revision, they try to make it a little bit clearer that the pass-through entity, the PTE, must collaborate with the subrecipient to come up with, a good situation. And we have found that the key is that with state and local governments, unfortunately, at times, they've been very forceful with their subrecipients and made them almost just say, you just have to go with the 10% de minimis rate. In Washington, D.C., that was a big battle. And the DC Council changed it based on the Nonprofit Fair Compensation Act of 2020, where their agencies, even whether it be federal or even DC appropriated funds, now they must negotiate with a past, with the subrecipient if they want if the subrecipient wants a higher rate than a 10% rate to show what the real actuals are. So there's this push and pull with certain city governments, and I'm sure some of you might be aware of that. And maybe in your locality, there are now new rules that are going through to try to protect you. Let's go to the next slide. Instead of going through this in detail because our time is a limit, it's just to let you know that if you choose not to use the DMR and you are a subrecipient to a pass-through, you can use something like the direct allocation method and allocate like rent, utilities, or telephones directly to your award. The government allows you to do that. So finally, the last slide is just so that you know that you may have seen that there's this federal acquisition regulation. So what happens is that if you are a nonprofit or recipient institute of higher education, your cost principles will always be under the uniform guidance subpart E, even if you have a FAR part contract. In reverse, if you're a commercial firm working on a grant, and there may be people listening, you still use the cost principles of a commercial firm under FAR Part 31.2. And the stress of the point here is that the FAR is quite different than uniform guidance. Under the uniform guidance, you have an indirect rate that's facility and administrative. But under FAR, for commercial firms, you even have something called overhead besides the G&A. So I'm going to turn it back over to Yev.
Perfect. Thanks, Paul. I think we have time for maybe a couple more questions, so I'll jump into those. So I think this one may be a good one for you, Joe. If an organization has a 15% incurred cost or indirect cost rate on all of its grants, should it at the end of the year transfer the full bucket of indirect cost to those individual expense items, so such as salaries, rent, etc., to be able to show that in the functional expense statement to meet the GAAP requirements?
So it's a good question, and I think it's a little bit in reverse order. You know, all these indirect costs, for the most part, are going to be in the management and general column of your functional expense statement. So they're already in those different categories of, you know, the natural classifications, if you will, of salary, rent, etc. So they're already presented that way from the GAAP basis. And actually, in our third webinar in this series, you know, Paul and I will be going through a calculation of starting from that functional expense statement and showing basically how this calculation, the mathematics of it work as far as putting them all into a bucket and allocating those costs to the federal projects.
Perfect. Thanks, Joe. And then real quick, in addition to that question, follow on. And is the organization, that example, required to keep documentation for that 15% of indirect costs incurred?
Yes, if they're using a NICRA rate and so forth, then yes, they'll need to maintain the documentation of how they calculated that, be able to support it. And the biggest part of that documentation is going to be in their audit report of the functional expense statement. And many organizations end up choosing to add to that a calculation showing how they arrive at their indirect rate calculation.
Got it. Okay. And then another question, this will probably be the last one we have time for. Do you need to get permission from the awarding agency to be able to use an amount less than the negotiated rate?
No, you don't need to. But what you would want to do in your cover letter, and I often help those who I help prepare, is state in there, hey, okay, our rate is 44%. We just want to let you know that we're offering a rate of 30%, below what our determined or computed rate is for negotiation, and the agencies accept that.
Got it. Thanks, Paul. And so with that, I think we're right on time. We'd like to thank everyone for participating and attending today's webinar. We encourage you all, obviously, to follow us on social media at GRF CPAs and to also visit our website, www.grfcpa.com, for all of our upcoming events and alerts. One last reminder, please remember to complete the survey that will appear automatically following this webinar once it's done if you'd like to earn the CPE credit for attending. Thank you all once again and have a great day.